So we're going to start into financial ratio analysis. I'm going to have you folks, and I'm also going to keep an eye on the clock here as well. And if at any point this becomes saturating, we should actually call it for the evening. And the reason I say that is because while this isn't necessarily hard concepts when they're deconstructed, it's dense. There's a lot of formulas and there's a lot of concepts to go over. So when it's time to be done, it's time to be done. The other thing that's very important too, and I'm actually going to move my camera to show the other two tables, is you're going to want to queue up the previous lecture on key financial statements. There are two sheets that are going to become really, really useful to you. The first is the balance sheet. And by the way, everybody here, I recommend that when we start talking about it, cluster around my second screen here, because then you'll be able to see what I'm talking about, because I can't project it up to there. But the balance sheet is one of them, and then there's another one called the Bartlett Company income sheet. And between the two of those, they actually explain a lot of these concepts and at least have concrete examples available for us to look at so we can understand what this fella is saying when he's saying it. So with that in mind, I'm going to queue it back up to balance sheet here. I'm going to bring this over here, and let's get started.
Hey guys, I am Deric. Welcome to my channel. In this video, I'm going to talk about financial ratio analysis. Financial ratio analysis involves methods of calculating and interpreting financial ratios, and this is to analyze and monitor the firm's performance. Management is concerned with all aspects of the firm's financial situation, and it attempts to produce financial ratios that will be considered favorable by both owners and creditors. Comparing ratios is more objective and relevant than simply comparing different figures from the financial statements. Let's take an example. Net profit of Company A is $100,000, while for Company B is $10,000. So, Company A has made more profit than Company B. Can we simply make a conclusion by saying Company A is better than Company B? Of course not. One more thing we have to consider is the sales. Let's say the sales of Company A is $1 million, whilst for Company B is $20,000.
Hey, come here. I gotta show you something. And this time, it actually might be your last chance to see this.
Nah, no last chances of financial
We
literacy.
calculate the profit margin by taking net profit over sales. So the profit margin of Company A is 10%, whilst for Company B is 50%. Now, it is obvious that Company B is better than Company A because Company B can make more profit based on lower sales, which means Company B is more efficient.
So that's just one ratio that you can use. Everything about this section is all about evaluating the health of a company. Or in the case, a more concrete case, for example, the health of how, say for example, a certain public school system is managing their funds and their money. By learning these concepts, we'll be able to dissect their budgets and how they are stewarding the money that they have taken from the taxpayers.
There are two types of ratio comparisons. First type is trend analysis or time series analysis. Trend analysis is used to evaluate a firm's performance over time. This is to compare the performance of one company over many years. Second type is cross-sectional analysis. It is used to compare different firms at the same point in time, which means it compares the performance of many companies in the same year. About cross-sectional analysis, you can either compare one firm's financial performance to the industry's average performance, which is called the industry comparative analysis, or compare one firm's financial performance to the performance of industry leader or key competitor, that's called benchmarking.
So I'm going to stop and pause for just a second and back up because there's one very important item that I parsed out of this when I was sitting down and learning from this, and that is when you're doing a trend. So first of all, trend analysis and cross-sectional analysis, one is an internal look and the other is an external look. But very importantly, these terms tell you essentially the data that you've collected, how it's basically the what are we doing with the data? How are we comparing it to either oneself over time or oneself compared to other similar companies in the industry. Now, I can say this, with FHPS and a lot of the other school systems, they're using cross-sectional analyses. They're comparing themselves to other school districts in the area. But if you are the stinkiest sock in the hamper, you're still a pretty stinky sock. The question really comes down to, how has the school system been doing compared to itself over time? We don't see a lot of trend-based analysis of the school system. They're doing cross-sectional, so they look good, but how is the trend going internally? Now, this tells you what you can do with the data you've collected. From here on out, we're going to talk about how to collect the data that you will use to make either trend analyses or cross-sectional analyses.
Performance to the performance of industry leader or key competitor, that's called benchmarking. In the following part, we are going to introduce 5 different categories of financial ratios. First, liquidity ratios, which is to measure firm's ability to meet its maturing obligations. Second, activity, efficiency, or asset management ratios, which is to measure how efficient a firm is in using its resources to generate sales. Third, debt or financial leverage ratios, which is to indicate a firm's capacity to meet short and long-term obligation. Fourth, profitability ratios, which is to measure the firm's ability to generate profits on sales, assets, and stockholders' investments. Fifth, market value ratios, which is to show the market's perceptions of a firm's performance and risk.
Whoa, 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 whoa. So I got to this slide and my eyes glazed over a little bit because first of all, when on first blush, I looked at this and I said, okay, what's the difference between number 1 and number 3 and number 2 and number 4? And then I had to go back and I had to say to myself, wait a minute, what's the difference between these financial ratio categories and what we had just talked about, the trend analysis and the cross-sectional analysis? Here's what I've come to learn. When we're talking about trend analysis and cross-sectional analysis, it is what we do with the data that we've derived from these ratios. How do we compare these ratios either internally over time in a company or these ratios against other companies in the industry? That's the trend analysis, cross-sectional analysis. But you have to get the data first. And this is the 5 types of financial ratio data that you can get. Here's what so this is skipping to the end and giving you basically the end of the story before the story's completed. Here's what I learned in a nutshell about each of these ratios. A liquidity ratio is all about, can the firm pay off its short-term liabilities, its debts, its leases, etc., without having to resort to take out loans or raising external capital. Essentially, the internal health of the company and how much cash, so to speak, it has on hand to pay its obligations. The activity efficiency asset management ratio comes down to how good is a firm in maximizing the liquidity of its profit margin. Basically, how good is it at keeping cash on hand to pay off all the liquidity ratio obligations? It's not necessarily talking about the profit margins themselves. It's talking about how liquid you can make those profit margins. In addition to that, there's also a section in the activity efficiency asset management ratios that talks about how well the company uses its assets to generate more money or get more profit. So that's what that's about. Okay, so then you say, okay, well, what about debt financial leverage ratio? So we talked specifically in liquidity that it's the firm's ability to pay off short-term liabilities like debts without resorting to taking more debt like loans. But a debt financial leverage ratio instead measures how much debt and how much loan the company has taken on to pay for these short-term liabilities and the long-term liabilities too. The profitability ratio doesn't talk about liquidity so much as how good is the firm at generating its profits. And then finally, the market value ratio, that's what is the market's perception of the firm's performance and the firm's overall health, the company's health. So that kind of hopefully demystifies a little bit of this going forward. So now we're going to go category by category, and we're going to take a look again at formula by formula. Now I'm going to start taking a look around as we go around the room, and when I start seeing glazed eyes and I start seeing people give the cut the mic sign, we're going to stop for the day. So.
Now, look at the first category, liquidity ratio. It is used to determine a debtor's ability to pay off current debt obligations without raising external capital. To calculate current ratio, we take current assets over current liabilities. Another similar formula is acid test ratio, in which inventories are removed from the formula. So, acid test ratio equals to current assets minus inventories over current liabilities. Liquidity is the ability to convert assets into cash quickly and cheaply. If the current ratio of a company is above industry average, it shows that this company is less risky than other companies in the same industry.
I'm gonna pause it right there because my eyes glazed over the first time I saw this too. So then I thought to myself, where can I get something that will show me this, or at least where the assets are, where the liabilities are? And that's when I remembered that key financial statements lecture. So I'm going to move this over here so you can see over here what we're talking about, and everybody cluster around if you'd like to see the balance sheet. So when we're talking about current ratio, we're talking about the current assets. So that is all of the short-term assets. That's the cash, that's the accounts receivable, basically everything that we haven't collected on yet. That's our current inventory and any other current asset. Now we're dividing that by the current liability. That's all this stuff. That's the accounts payable. So basically, what do we have to pay to our manufacturers? The short-term debt that we owe, and any other current liabilities. So the current liability is the short-term liability. This is all short-term stuff. And so when we take the current ratio, we're taking the current assets and dividing it by the current liability. Now, here's where it gets messy. You don't really know how liquid you are if you're factoring in stuff that you can't really sell off in a hurry because you are the infrastructure and so on. In addition, if you have inventory, stuff that you have that is potentially money that is not yet realized, you're not very liquid if you have, your product. You need to get that product moved and you need to get it turned into cash. That's where the concept of the acid test ratio comes in. It basically takes all the current assets minus your inventory. So essentially, what have you already sold and got cash on? What have you already sold and you're waiting on outstanding notes for? And then divides that by your current liability. Now, you can imagine if we go back to the liquidity ratio section here, if you're above the industry average, that means that the numerator has gone up. And so that means, especially with the asset test ratio, that means that your current assets must have increased greater than current liability. So you factor out the inventory. So that means you've got much more cash on hand. That means you're more liquid. That means you're less risky than the other companies in the industry. Before I unpause, any questions on that?
For current ratio, the higher the better. However, sometimes high current ratio is not necessarily showing better liquidity. It could be due to high inventory level that causes current assets to increase, indicating a firm's problem in inventory turnover. That's why we have another formula for liquidity, the acid test ratio, or quick ratio, which is more stringent as the illiquid inventory is excluded from the current assets. Let's take an example. Let's say there are three companies, Company A, B, and C, and their current ratios and quick ratios are shown in the table. All three companies have current ratios of 1.3. However, the quick ratios for company
Quick ratio is
and
acid
company
test
C
ratio.
are dramatically lower than their current ratios. But for Company A, the two ratios are almost the same. Why? The reason is because Company A does not keep much inventory compared to the other two companies. Therefore, Company A is more liquid. The next is X.
Now, if we take this, here's where this gets turned a little bit on its head, right? So if we take the example of the school system, do we really want to have a high current ratio or a high acid test ratio? On the contrary, I would argue that we want more inventory, i.e. more books. We want more, infrastructure in for the school. We want enough so that we can pay off any sort of short or long-term debts. But at the end of the day, having a high current ratio or a high asset test ratio in a school system isn't necessarily the most important thing. And so while this is important for, companies on the stock market, it's not necessarily something that we would worry about, particularly if they were touting that towards us, saying, wow, look at how much cash that we've got on hand. Look, we saved this much. Well, why aren't you sinking that back in to the system itself? So it's a little different for the school system as compared to corporations. So we just did the first set of financial ratios. Any glazed looks, or shall we continue on? I see soldiering on. Okay, let's soldier on. This is the biggest chunk. Activity, efficiency, and asset management ratios are large, but we'll go through them bit by bit.
Activity ratios. They are also known as efficiency or asset management ratios.
Never leave your wife in bed without reaching the final moments again. This is capable of making your member
Oh my God. Well, let's not talk about that. Oh my goodness.
Turnover is calculated by taking credit sales over accounts receivable.
That's an Easter egg for anybody who watches this.
The amount of money that customers have not yet paid back. Accounts receivable turnover shows the number of accounts receivable a company collects during a year. In other words, it shows how many times the customers make payment to the company during a year. For accounts receivable turnover, the higher, the better. Another alternative is to convert the turnover into period, which means how many days. Average collection period is calculated by taking accounts receivable over credit sales times 365 days. Average collection period shows the average number of days accounts receivable remains outstanding, or it means how many days it takes for customers to make payment.
Okay, so I'm going to pause that right here, and we're going to try and break this down. So on the balance sheet section, there was an accounts receivable. That was basically the uncollected money that is owed to the company for the goods that are delivered. When I started parsing out credit sales, I took that to mean that amount of money which the company had already received. Now you can say that that might be the cash that had been received from the sales at that time. You want this number to be high, because if you have this number high, it essentially means that you've received more of the cash money, and there's less credit, or you haven't given out goods without getting a compensation in return. That's why they're saying the higher the better. The average collection period, you just basically invert the numerator and the denominator to multiply by 365, and it gives you just about how much time it takes for you to basically collect on the money that you are owed by the person that you have sold the goods to. If this number is particularly high, you either have a very relaxed or inefficient payment plan, or you have unreliable people that you've sold goods to. You've got welchers, basically. These are in a way a measurement of the liquidity of the company and how much cash is on hand and how much unrealized cash still needs to be collected. Now, what's important about accounts receivable turnover and average collection period is these ratios have to do with getting money from your customers into your company. The next two ratios that we're going to talk on the next slide will focus on the money that the company owes to its suppliers.
The shorter, the better. Shorter average collection period means customers take shorter days to pay back money. Higher accounts receivable ratio or shorter average collection period may imply the following. A company operates more on a cash basis. When customers pay by cash, then accounts receivables will reduce. So accounts receivable turnover ratio will become higher. A company is efficient in the collection of accounts receivable, which means the company can collect outstanding balances pretty quickly, probably through frequent reminders, clear invoicing, and timely follow-up on late payments. The company has high proportion of quality customers in which the customers are reliable and financially stable. So these customers are more likely to pay their bills on time, resulting in faster collections and a higher turnover ratio. The company has a conservative credit policy regarding its extension of credit. For example, the company offers a shorter credit term to its customers by requesting them to pay in a shorter period, which may result in faster collections and a higher accounts receivable turnover ratio. The company may only extend credit to customers with a good credit history and prompt payment records. Industry norms in which the accounts receivable turnover ratio can vary depending on the industry. For example, some industries, such as retail, have shorter payment terms, which can lead to a higher turnover ratio. Therefore, a high accounts receivable turnover ratio in one industry may not necessarily be considered high in another industry.
So a good example of that would be something like groceries versus something that is much more solid, like say furniture, where you don't make the purchases nearly that often.
Next, accounts payable turnover.
So we went from receivable to payable. So receivable is what we get from the customers. Payable is what we have to pay to our distributors. Or sorry, not distributors. The folks that manufacture for us.
It is calculated by taking credit purchases over accounts payable, in which accounts payable means the amount of money that the company has not paid back to the suppliers. Accounts payable turnover shows the number of accounts payable a company pays during a year. In other words, it shows how many times the company makes payment to the suppliers during a year. For accounts payable turnover, the higher the better. Higher accounts payable turnover helps the company build a good credit with the suppliers. Another alternative is to convert the accounts payable turnover into average payment period.
Washington homeowners, we need to talk. Solar works in Washington.
You clearly don't know we're not in Washington.
Average payment period is calculated by taking accounts payable over credit purchases times 365 days. Average payment period shows the average number of days a company takes to make payment to the suppliers.
So these formulas are very similar to the previous ones we looked at, but as I mentioned, these are the ratios that the bank creditors or upstream material suppliers are most interested in because it shows how well you are at paying off your debts to them and how long it takes you to pay off your debt. That means that you're a more of a reliable person for them to give loans to or extend credit to if you're able to turn this over quickly. But some of this also comes down to how quickly you can move your inventory. So it doesn't necessarily mean that if these numbers are low that you are delinquent. It has to do with where you are. So this is where that whole idea of cross-sectional analysis comes out, where you are as compared to other companies that are similar in the industry.
The shorter the better. Generally, lenders and credit suppliers are more interested in accounts payable turnover ratio. This ratio may affect the supplier's decision of giving how much credit sales and how long credit terms to the company. Higher accounts payable turnover ratio or shorter average payment period may imply the following. A company has an efficient accounts payable process so that it can process and pay invoices more quickly, resulting in a higher accounts payable turnover ratio. A company is taking advantage of early payment discounts offered by suppliers, causing it to pay invoices more quickly to obtain the discount. Fast-moving consumer goods industry, such as retail industry, usually has shorter payment periods than others.
Walmart's going to be quicker at paying this off than Joe's piano store.
The
Basically.
company receives cash more quickly from its customers. It will be able to pay the suppliers more quickly as well. Next, inventory.